If you're a higher rate taxpayer, it's now become more important than ever to make sure your investments and savings are held as tax efficiently as possible. Mr. Sunak and Mr. Hunt have brought down tax allowances significantly, meaning everyday interest in your bank accounts or gains and dividends you make from investments are going to be taxed a lot more. So it's important you're on top of this and look at ways you can save yourself tax. Sometimes a tax saving is even better than an investment return. My name's Carl Roberts. I'm a financial advisor at RTS Financial Planning. And in this video, we're going to go through some of the ways you can make sure your investments and savings are more tax efficient. So what's been happening? Well, the Chancellor announced in a recent autumn statement that dividend allowance will be cut. So a dividend allowance is available for dividends. So if you invest, you hold shares in a company or units in a fund, those companies will obviously make profits and we usually distribute those profits as dividends. That's a dividend payment to you. The dividend allowance used to be £2,000, but it's now gone down to £1,000 in the current tax year, 23-24. Next tax year, 24-25, the dividend allowance is going down to £500, just £500. And there's also been some significant drops in the capital gains tax allowance. So again, if you hold shares or units in a fund and you sell those shares and you've made a good gain, sometimes you can use what's called a capital gains tax allowance. So you'll be allowed to make a certain amount of gain before capital gains tax applies. Well, the capital gains tax allowance has been cut to £6,000 in the current tax year, 23-24, and will be reducing further in the new tax year, 24-25, down to £3,000. So unless you're holding your investments efficiently, your tax is going to increase quite significantly very soon. Even cash held in savings accounts will face some severe tax hits, particularly if you're a higher rate taxpayer. Now you may remember there's a thing called the savings allowance, which means you can earn up to £1,000 of interest on your savings if you're a basic rate taxpayer. But if you're a higher rate taxpayer, you can only earn £500 in savings interest before that is taxed. And also savings interest is now paid gross. So it's up to you to be on top of this and declare this to the HMRC. So what can we do? When it comes to tax efficient investments accounts, there's the simple and then there's the complex. And you need to be really careful about the complex solutions. So quite often for higher rate taxpayers, you'll be marketed things like enterprise investment schemes, EIS, venture capital trusts, VCTs, and others. And these schemes can work great, but they involve a lot of risk. They usually involve you investing into much smaller, volatile companies, some of them even startups, but you will get tax relief up front. So you'll get a refund off your tax bill essentially. But the catch with these types of investments is it can be very hard to sell them afterwards. And a lot of the time, the companies don't do a lot. If you look up all the startups in the UK in any one year, only a tiny proportion of them actually make it as successful businesses. So for every sort of 10 companies you invest in via one of these schemes, you might get one winner, but 9 losers. So you really need to think about the underlying investment when you're looking at these types of schemes, and also what's the exit strategy. Quite often you can invest into an enterprise investment scheme, an EIS scheme, and although you get tax relief as long as you hold the shares for 3 years, it's very unlikely that the company can be sold after 3 years because it's a private company at the end of the day. So your money is usually stuck there then, sometimes for 10, 15 years, when actually if you'd invested that money in just a normal investment and paid the tax, you would have had a better overall return. So just be very careful about those types of investments. What we're interested in today is the simple investments, the really quick, easy wins. And these are things like, number one, your pension. It sounds boring, but the pension is still the most fantastic way to save tax, particularly for higher rate taxpayers. For example, if you're a higher rate taxpayer, if you make a £16,000 pension contribution, that will be topped up automatically by the pension provider up to £20,000. So you'll pay in £16,000 and the pension provider will claim tax relief from HMRC and top that contribution up to £20,000 for you. So £20,000 is now sitting in your pension. A great return already. But what's more, for high rate taxpayers, you can claim a further £4,000 on your tax return. So you've paid in £16,000, but you've got £8,000 worth of tax relief here. Looking at it another way, a £20,000 pension contribution has only actually cost you £12,000. Now, yes, some people will say, well, you're going to pay tax on pension withdrawals eventually. And that's true. But you can be a lot clever now with the way you withdraw from your pension fund in retirement. And it may be that you're not a higher rate taxpayer in retirement. It could be that you're a basic rate taxpayer. Or for a period, you may pay no tax at all. So you're getting all the tax relief up front now while you're a higher rate taxpayer. And then when you're in retirement, you might pay little tax as possible with some clever withdrawal strategies. Now, the one good thing that was announced in the autumn statement is that the pension and the allowance has increased to £60,000. And don't forget to use your partner's allowance as well if they have the earnings. Okay, number 2, the next simple, efficient product for tax efficient investments is the ISA. So you may be familiar with an ISA from your bank account, a savings ISA, cash ISA, but what we're talking about here is a stocks and shares ISA. So you can invest the same way you do with your pension in pretty much anything, but via an ISA wrapper. And this is the most simple tax efficient product you'll come across. Money you put into an ISA, you invest into an ISA, grows completely tax-free. There is no capital gains tax. If you make a huge gain inside your ISA and sell those shares inside your ISA, no capital gains tax. Any dividends you earn, any interest you earn in your ISA, completely tax-free. There's no dividends tax on an ISA, and you don't need to worry about dividend allowance. So a really simple, easy product. The only downside is you're limited to putting in £20,000 per year into an ISA. But if you're a couple, obviously that's then 40,000, 20,000 each. And also if you've built up cash ISAs in the past, maybe you've got a significant amount of cash ISAs, 50,000, 100,000, you can actually transfer that money straight to a stocks and shares ISA. And you don't need to worry about the £20,000 limit because an ISA is an ISA and it's just a transfer. So ISA is still a really good way to be tax efficient with your investments. If you've maxed out your own ISAs, think of an ISA for your children. There's a new one called the Lifetime ISA. And this can be really handy for young children and you want to help them save for their first home or even for their future retirement themselves. You can put up to £4,000 into a Lifetime ISA, but the government will give you a bonus of 25%. So that will top that amount up to £1,000. And you can use that money and take it out to buy your first home. If you don't buy your first home, you have to keep it until retirement. But still, another handy way to save some more tax. And the final product we're going to look at today, number 3, is called an offshore bond. Now this is a little bit more complex and it's a bit harder to get your head around, but essentially you can invest a large lump sum into an offshore bond. And because it's and these are offered by very well-known brands, insurance companies, but they base themselves in the Isle of Man usually, or another non-sort of tax jurisdiction. And it means that investment funds in these bonds can grow pretty much tax-free. Now there is quite a complex and fiddly tax calculation to work out if you want to eventually sell those bonds and take the money out. It will depend on the gain that you've made. But you can do some clever things with assigning different parts of the bond, perhaps to your children, or again, if you're a lower rate taxpayer when you come to retirement, it could be a good time to cash it in at that point. So this is kind of, I would definitely use your pensions and ISAs first, but if you've sort of maxed out them, look at something like an offshore bond for larger lump sums to be a bit cleverer with. But what's really crucial with whatever tax wrapper, whatever product you decide to use, is vitally important to check the underlying investment strategy. It's no good saving a lot of tax, but your money's just sat in a rubbish bank account, or you've picked a really poor, low risk investment that's not going to give you any return. Follow an evidence-based approach and pick the investment strategy that's right for you for achieving your financial goals. I hope you found this video useful. Please subscribe to the channel because there's going to be a lot more videos coming and you won't miss any that come next.